Hello there, Fireball here with a simple scenario for you. Let's say that you have some surplus cash and you decide to just leave it in a savings account. By surplus, I mean cash you won't be needing to spend for at least some time. The savings account gives you 3.5 to 4% annual interest, and the annual inflation rate is about 5.5%. So you're losing about 1.5% of that value annually by doing nothing with it. Those who are more conscious of this but are risk averse will use fixed deposits to earn around 6% at current rates. This does save you from inflation to some extent, but your money doesn't really grow, nor does it protect from a spike in inflation. Yet you're scared of capital devaluation. An obvious answer appears in form of debt mutual funds, claiming to give you 10 to 14% in return and safety from risky investments like equity. Or is it? Maybe. Let us look at debt fund investment and if it makes any sense for an individual investor. What is debt fund? It is simply a pooled investment which buys debt issued by government, banks, public works like National Highways Authority, LIC, or NBFCs or corporations like Reliance and L&T. Let us look at the relevant aspects and considerations in a debt fund investment decision and identify benefits. First, we look at their investment or income method. Let's say the fund today buys bond in multiples of Rs 1,000, which pays annual interest at 8.8%. In this slide, we can see the cash inflow which is expected from this investment over the next 5 years. Do note that this interest or coupon rate is usually given as choice, monthly, quarterly, semi-annually, annually, or even continuously compounded. Most investors know the power of compounding on investments, but do realize that the funds are also aware of this, so the interest rates are calculated in such a way that no matter what option you choose, you'll be making about the same in a given time period. Simply because to earn benefit of, say, monthly compounding or earning interest over interest 12 times, you need to be able to reinvest at same rate or higher to beat annual compounding rate, but that is highly unlikely for individuals. Let us look at the effective yield in this NCD issued by L&T Finance. It is same for investment period of 36 months, whether compounding is annually or monthly. We can go into this in more detail in a future video. In this slide, you can see that interest of Rs 88 is received annually, and in the 5th year, interest of 88 plus principal of 1,000. And one fund will have hundreds of such investments which will have different maturities, coupon rates, risk ratings, and so on. But the investor does not earn this. He or she earns from the changes in NAV or dividend paid by mutual funds, if any. Using the same method for calculating value of a bond at a given point in time, the mutual fund will calculate the daily present value of all their investments, aggregate and divide by total number of units and determine NAV. Coupon rate does not change during the life of a bond issue, but the discount rate that we used or interest rate of borrowing in market from banks or other sources changes. Rates like LIBOR can change daily. Repo rate, CRR, and other rates by RBI can change frequently, which will impact the present value calculations. So, while the cash flow expected is roughly fixed, the value of investments will fluctuate. Also, this is the reason why investor returns can be less than 10% even if a mutual fund invests 100% of its funds in 10% interest-paying bonds, and this is without considering taxes. Now, who all take a share out of your return? Individuals earn return in form of dividend income and capital appreciation. Both of those are taxed when the asset is a debt mutual fund. In case of equity mutual fund, short-term capital gain tax is 15%, and long-term capital gain is 10% above Rs 1 lakh. Then there is management fees which goes towards paying the analysts, evaluation staff, management, and other staff. Any dividend distributed by the fund to unit holders also requires additional 29% as dividend distribution tax which is paid from fund assets. Then when an investor sells the debt mutual fund, the fund will take a cut from the exit load, which can be nil or as high as 10% in some cases. This is taken from the capital gain or profit and not from your initial investment. When looking at debt funds, investors will come across modified duration and yield to maturity. Simply put, yield to maturity is the rate of return for investing in the fund and holding it till all its current investments mature. In the initial example, 7.4% is the YTM for a bond valued at 1,057, paying at 8.8% coupon and having face value of 1,000. Modified duration is the sensitivity of the fund to changes in YTM rate. So if the duration is high, say 5, that means for 1% fall in YTM, value of a fund or NAV should rise by 5% or vice versa. However, take this as a rule of thumb for small changes in YTM, like up to 0.25%, because duration ignores convexity and bond price to interest rate changes along a convex curve. For someone wondering how it is calculated, it can be done by using basic slope formula of y2 minus y1 upon x2 minus x1. Basic understanding for an ordinary investor. Duration is sensitivity. Higher duration means more susceptible the fund is to change in rates. But then why would anyone buy a high duration fund? A lot of companies like banks, insurance companies, pension or investment funds have liabilities that have fixed cash outflows, the inverse of investment in a bond. So when a person or company has cash outflows, it makes sense to prepare cash inflows in a way that cash comes to them when they need to expend it. Usually, cash flow matching concept is very complicated and cannot be easily planned for, say, 10 years by any company. So, they practice duration matching, which here refers to the average waiting time where the price and reinvestment effects cancel each other. Now it comes very close to the modified duration we saw earlier, except it does not depend on YTM. So now, say a pension fund has a set of liabilities or cash outflows for the next 7 years, and this liability has a duration of 5 years. The pension fund has some cash now. It would make sense to invest in a bond or debt fund which has duration of 5 years to match their asset liabilities and have low or no risk. Now this is just one brief insight into why duration matters. It is a very important tool for finance and investment managers, but not exactly for retail individual investors. Now recall how we usually associate risk to be low in debt funds, and now realize the duration is also an indicator if not an actual risk. Higher duration equals higher risk, but this is not the only risk. Credit risk of the corporates whose bonds have been bought by the fund. Especially short-term funds, it is possible that a fund has invested in debt by risky issuers in an attempt to earn high coupon amount. Here the probability of default is high. I will direct you to another term that comes across when one looks at the bond funds. Pass-through certificates, or PTC. This is an instrument using which trusts and private entities can issue bonds by giving collateral. The quality of collateral is unknown. The real lenders may sometimes use shell entities to raise funds via PTC, bringing to question the transparency, value of a rating by a rating agency if any at all, and the risk of investing in such debt. Not to discredit the bona fide entities raising funds using PTC, I advise investors to be diligent. It has been seen that when a fund underperforms, the fund managers may be motivated to make up for losses by buying more risky bonds, which can be even worse for investors. Most fixed income securities are not liquid. Liquidity means that we can get the fair value for exchanging the asset, and lack of liquidity is a risk more prominent among fixed income than equities. Valuation issues exist because a lot of bond market transactions happen over the counter instead of exchanges, so less transparency, and that just adds up risk. Most funds will value their bonds themselves, or outsource other firms to calculate daily NAV. Now, they never release their financial models or assumptions, which are usually proprietary, so let us accept that there may be some model risk as well. So, debt fund is risky, right? It is just that investors aren't always told about the hidden risks. A lot of time, investors may find that a fund has invested in sovereign or government bonds, which surely has no default risk. But it does have credit risk. How so? Well, increased government spending and borrowing for repayment of interest is not unheard of. This usually has an impact on the exchange rate of local currency, leading to an indirect impact on purchasing power. In a similar way that interest rate changes also have impact on purchasing power of local currency, but so far we only looked at it from the bond value perspective. Countries even have ratings. India has a triple B rating, which is the lowest of investment grade. This tells us that maybe investing in foreign government bonds is still safer than Indian government bonds. Given this, fixed deposits seem simple. But is it risk-free? Alternatives to debt funds. I'd suggest sovereign gold bonds because not only do they protect against inflation, they also provide reasonable capital appreciation expectation along with the collateral. Or just buy government bonds at your local bank, as you will get the interest cash directly than through a fund. Overall, I do not recommend individuals to invest in debt funds as their primary investment. During boom or times of economic growth, there is a case to invest in them, but during recession or times of contraction, they are amongst first to completely collapse. If it makes sense financially for, say, diversification of investments, where someone has invested solely in equity and real estate, then considering the economic cycle, there can be a case. Otherwise, perhaps best to invest in gold bonds and or just directly buying government bonds. Thank you for your time. Do comment if there was something you did not understand or like, or would want me to focus more on in future.